Well, for more on this, let's bring in economist Isaac Cohen. He's the president and CEO of Invaway. Welcome to the show.
Nice to meet you.
So, Isaac, what were the biggest takeaways for you from Fed Chair Yellen's testimony?
Well, I guess she recognized that the U.S. economy is, she said, on an even keel in the sense that it's growing moderately at about 2% a year, which is reasonable. Unemployment is down to 4.3%, and inflation is probably where there is a shortcoming in the sense that inflation is lower than the objective fixed by the Federal Reserve. But that's not so bad. I mean, it could be worse in the sense that if it goes over the objective, then they're going to have to step on the brakes much more.
Right.
Now, that means that we're going to have probably another interest rate hike during the year, and the Federal Reserve has said that they want to start lowering the amount of their portfolio because.
I'm sorry. Go ahead.
No, because they do have a lot of money in bonds, you know, that they need to get rid of.
And we'll certainly get to that. We know that Yellen said that the Fed was nearing its neutral rate, meaning that the benchmark rate neither dampens or boosts the economy. So what does that mean then in terms of the pace of some of the future rate hikes we might see?
Well, yes, since the economy is approaching almost full employment, because 4.3% unemployment is very low, really. From there on, either since the reactivation is already 9 years old, there may be a concern that we're going to face another recession. But for that purpose, the Federal Reserve needs to have the tools in order to counter such a possibility. And increasing interest rates will allow them to be ready in case this may happen.
So does the Fed have enough tools in its toolbox if a recession were to happen?
Oh, yeah, there is enough. Of course, the problem is that now interest rates are very low still. It's 1.25%. So in order to lower that, that would be very close to zero. So they need to go up a little bit more. So we're going to have a couple of, perhaps one other increase this year, and they're going to start getting rid of the bonds. They already said they are going to, but they didn't say exactly when.
Yes, they didn't say much about the $4.5 trillion that they have on their balance sheet, obviously a measure that they took in response to the global financial crisis. Are you surprised that we didn't hear more at this point?
Well, no, because in June, when they had their meeting, the Federal Open Market Committee meeting, they said what they were going to do. They're going to start letting these bonds mature to term, and then they're not going to repurchase. So that will lower the amount of money that the Federal Reserve has in its vaults.
Now, we saw that most of the Fed members didn't really factor in the Trump administration's intentions when it comes to some of its big policy changes, which they've seen talked about, like the tax cuts, immigration and trade, but not actually put into practice. How much could that shape what happens with monetary policy going forward?
Well, the problem has been that monetary policy has been playing a lonely role, I would say, because fiscal policy has not accompanied whatever the central bank is doing. The hope was that with the victory of the Republican Party, the control of the Republican Party of both the House and the Senate and the White House, that would lead to, more active programs of fiscal policy, like lowering taxes, spending much more money in infrastructure. Unfortunately, that's not the case. The Republican Party stands divided and has been unable to approve all these things.
And in terms of the global landscape, any potential headwinds you think could perhaps throw off the U.S. economy?
Well, actually, there's some good news there. You know, Europe is doing better, less concern about Europe, and Japan is moderately growing again. So the industrialized economies are doing relatively well. Now, emerging markets are undergoing a certain degree of difficulty because particularly commodities have gone down. And this is due because of China's slowdown, because China is the main purchaser of commodities in the world. So once demand from China goes down, prices of commodities go down, and that hurts emerging markets. But, you know, this may be a transitory situation, and China will, I guess, refocus its economy more on the domestic market, and that will increase demand.
And we'll certainly see how that changes the relationship. Thank you so much, Isaac Cohen, President and CEO of Envoy LLC.